Okay, welcome to the Swedish House of Finance. The Swedish House of Finance is a research center in finance located at the Stockholm School of Economics. My name is Per Wisén. I work at the Swedish House of Finance and I will moderate this seminar. The topic for the seminar is really a simple yes or no question. Should we worry about the rising public debt? So we could make this an ultra short seminar by just collecting the yes or no's and that's it. And that's obviously not what we are going to do. The answer to this question has very many components. There are very many problems that goes into this. And this is one of the hottest debated topics, both in academia and among practitioners right now. Rates are close to zero. What does that matter? Rates have historically been much higher, but rates are close to zero and lower than the expected growth rates. Does that make debt less dangerous? How can we tell if a certain level of debt is sustainable or not? If it can explode or do strange things? Does it matter what a government uses the money they borrow for? Does it matter if the country borrowing is the US with the world's reserve currency and the safe asset of the world, or if it's Sweden with a rather small currency? And there are many more questions like this. And what we will do is to give you an academic perspective of these questions. There is research, there are models, there are lots of clever researchers working on this, and we will give you a summary of what theory, academic research says about this. And we will give you the practitioner view. People who are working in this, how do they look upon the topic? So that's the setup. And we are Irina Zviadadze, Associate Professor of Finance at HEC in Paris. HEC, that's HEC in more English. That stands for École des Hautes Études Commerciales de Paris. And she is also a Bertil Danielsson visiting professor at the Swedish House of Finance and has worked here in Stockholm for a number of years. Her research is focused on understanding the sources of risk premia in foreign exchange markets, understanding properties of the term structures of asset prices, and developing diagnostics methods for macro-based asset pricing models. And she has presented papers on major conferences and published in the most prestigious journals. And Irina will have 20 minutes to give us an overview of what research says on the question of whether we should worry about rising public debt or not. After Irina's introduction, Kristin Magnusson Bernard, currently CEO of AP-fonden, will give her comments. Kristin has worked most everywhere in these fields. She has been at Nordea for a number of years as a macroeconomist. She's been at the European Central Bank. She's been at the European Commission. She's been at the International Monetary Fund. And she also has a PhD in economics from the Stockholm School of Economics. And to top it all, she's also at the Scientific Advisory Board of the Swedish House of Finance. So Kristin has done it all and has lots of experience to share with us on sort of how we should look upon this puzzling question of public debt. And our third panelist is Martin Åström. He is policy officer at the Task Force for Relations with the UK at the European Commission. And he has held various positions at the Commission since 2007. He has a Master of Political Science from the University of Lund. And since the EU, we very much wanted somebody to talk about what's happening in the EU with the Next Generation EU project, with borrowing and big projects starting. We are very much interested in to see how the EU Commission looks on these topics. So, and we also have a great audience, large and great audience out there. And I know that many of you have views on this. So please use the Q&A function and write down questions or comments, and I will read of them, provided there is time enough to read them all, and we can have a discussion. And with Irina, 20 minutes and 10 each for the other panelists, we will have roughly half an hour for a discussion, rounding it off. So very much welcome, all the three of you, Irina, Kristin, and Martin. And Irina, now you have our full attention for the next 20 minutes, please.
Okay, good afternoon, everyone. Thank you very much, Per, for the introduction. And thank you very much for inviting me to this webinar. I'm very happy to share with you some of the views on the topic, should we worry about the rise in public debt? And as Per already introduced my role here, I'm going to basically summarize what academic research has to say about this topic. So how academics think about government dynamics in the recent past, given the COVID shock, and what are the problems that people contemplate, and what are the views of people. So, but I would like to start by just introducing key numbers, which many people know. So I will start with giving some sovereign borrowing outlook and emphasize what was the impact of the COVID crisis. And then, because research on government dynamics, on government debt dynamics and debt properties and the relationship with macroeconomics and asset pricing is very rich, 20 minutes is obviously not enough to touch upon all the issues. So I chose three main issues I'm going to be talking about today, which are government debt sustainability problem. Then I will be talking about whether markets view government bonds anyhow special and what it means. And then I will comment on how we think about the interplay between government debt and asset prices. So these three main points. So let's start by thinking about, in general, how we measure debt. So usually when both financial press and also academics talk about financial fiscal resilience and about fiscal policy, about debt levels, then there are at least two key benchmark indicators that people have in mind. One is debt to GDP ratio, and the other one primary deficit to GDP. So obviously comparing debts in nominal values doesn't provide you much information because countries are very different in size. That's why we here normalize by GDP. Yet, if you think about GDP, which is a flow variable that shows up in the denominator, debt is going to be a stock variable. And debt to GDP ratio per se, as we will see in my presentation today, is not the sufficient statistic in order to understand whether a country is healthy in terms of debt level. Primary deficit is going to show how much money country government generates by collecting revenues and paying off some of these expenditures, how much money is left, for example, to cover interest rate payments to service the debt. And so there are a few numbers out there that people like to refer to when they try to understand whether the situation with the levels of government debt is worrisome or not. So some numbers are coming from the researchers of the World Bank. For example, Grant, Gunner, and Coiler-Gabe provides tipping points for the level of debt to GDP ratio for both developed and developing countries. And so they basically argue that there are some levels of debt to GDP above which a country doesn't want to go, just because every additional percentage point of debt would cost in terms of economic growth. And so these numbers are 77% for developed countries and 64% for emerging countries. So obviously, as you see, there is a different room for maneuver for developed and developing countries in terms of raising debt, even from these basic numbers. And we will see how these numbers compares to the numbers that we see in reality, so right now and in the recent past. So there are also numbers that are more related to European countries within which constitute European Union, and so they are basically part of EU Stability and Growth Pact. So EU has standards for its members in terms of conduct of monetary policy, in terms of fluctuations of exchange rate if countries didn't adopt euro, but also in terms of fiscal policy and in terms of these benchmark numbers for deficit to GDP and debt to GDP ratios. So deficit to GDP ratio has to stay less than 3%, whereas debt to GDP ratio has to be below 60%. So these are the recommended numbers, but now let's see on the dynamics in the recent past of debt to GDP ratio. So here you see dynamics for advanced, emerging, and low-income developing countries, and you see the dynamics are pretty different. And so first of all, something that you pay attention to immediately is that the level of debt to GDP ratio is much higher in advanced economies, and it has been growing since basically the financial crisis of 2007, 2008, 2009. And as you see here, there is a huge leap which takes place in 2000, and this is basically the result of the COVID shock. Similarly, there is an increase in debt to GDP ratios in middle economies countries and emerging countries, but less so. Now, if you remember the numbers that I've provided to you on the previous slide, you could see that on average, developed economies were having higher debt to GDP ratios than both numbers suggested by World Bank researchers as tipping points, and both higher than numbers suggested by European Union. So debt to GDP ratios have been quite high for some time, and recent COVID shock obviously didn't help to decrease the level of debt. So now you can zoom in and look at country by country change in debt to GDP ratio due to the COVID shock. So the most developed countries experienced the highest changes. Among them are Canada, Japan, United States, United Kingdom. And now if we actually look at the map of how country by country sovereign debt looks, and here again, you see debt to GDP ratio. So by colors, you see that there are different segments, and the countries which are mostly in deficit are the developed countries, as we have already seen. These are Japan, this is United States with Canada, but also big European countries like France, Germany, United Kingdom, Spain, Sweden. Since we are talking, since this webinar is taking place in Sweden, at least virtually, Sweden is doing much better if we just look at raw benchmark numbers in terms of debt to GDP ratios. So Sweden is in the bracket of 25–50%, so well below to what both World Bank would recommend to be at, and also European Union. So this is heterogeneous, so we see the heterogeneous level of debt to GDP ratios. So debt to GDP ratio is not the only benchmark indicator usually people look at. So people think about, people define that as basically a sum of expected discounted surpluses, future surpluses, and obviously what people pay attention to is also the dynamics of the deficits, because if there are big deficits, these deficits are going to mechanically increase debt going forward. So if we look now at expenditures, revenues, and primary balance, which is the difference between expenditures and revenues for different type of countries, what we see is that during the COVID shock, developed countries, most advanced countries experienced the largest growth in expenditures. In terms of revenues, it didn't change much, just a very flat profile with a slight decrease in revenues in advanced economies, but much larger decreases in revenues in emerging and low-income economies. And as a result, now we can look how primary balance looks. And obviously in this period, this primary balance is going to be negative, so we're going to see deficits. So during COVID shock, we see a huge deficit in advanced economies. Numbers are pretty large, but not, I would say, historically very rare numbers. So if we see a few decades back, during the financial crisis, numbers were not as large, but pretty sizable as well. And so the largest deficits are experienced by advanced economies just because advanced economies spend much more money and as a result, increase the level of debt. But how we can rationalize all these numbers? So what should we think about these numbers? How we can make sense of these numbers? So the high levels of debt to GDP ratios in advanced economies, does it suggest that these are most risky economies now as it concerns fiscal policy? So what can we say about that? So now I would like to start giving you overview of what academics think about different problems, and I will start with debt sustainability. So debt sustainability is intertemporal solvency of debt, so intertemporal consistency of the debt policy. So can government budget constraint can be sustained period by period? So there are very old studies that were already looking at this problem. So one of the most famous ones is by Bond, published in Quarterly Journal of Economics. And so here he was looking at so-called fiscal corrective measure mechanism. So the idea was to understand what happens with government surpluses upon increase of debt to GDP ratio. And what was documented empirically is that if debt to GDP ratio increases, there is associated increase in government surplus, which means that when government takes on extra debt, government commits to generate surplus in the future. And so this fiscal corrective measure was interpreted as evidence of debt sustainability. Mendoza and Åström looked at the same problem in international context. However, a bit later, a number of authors, Gosh, Kim, Mendoza, Åström, and Kuresh, noticed that it must not be enough that government surplus increases upon increasing debt to GDP ratio to sustain government budget deficit all the time. And one reason is very simple, is just because the rise of surplus to GDP ratio is limited by at least ratio of 1. You cannot always push surplus higher and higher. So surplus cannot increase GDP. Surplus is usually much lower than GDP. So there is also another reason, and another reason is basically just the idea that, for example, if government wants to collect more revenues by means of increasing the tax rate, at some point, the collected revenue is going to decrease upon increase of the tax rate. And this is because revenue of a government from tax collection is not a monotone function of a tax rate. There is a Laffer curve. And all of what it means is that there is a debt limit. So there is always a level of debt beyond which you cannot really push. And in the finance literature also, there's the difference between debt limit and current level of debt is called fiscal space. And many researchers have been working on understanding what are the fiscal spaces for different countries. So going back to the idea of fiscal corrective measure, using recent evidence or recent data, a number of co-authors, a number of researchers, Jan Lustig, Van Nieuwenberg, and Xiolan also documented that there is not actually strong evidence in terms of predictability of primary surplus debt to GDP ratio. So it's not clear if we have even a weak notion of debt sustainability in terms of fiscal corrective measure in place in the data. So what can we say next about high levels of debt and these high levels of debt associated with very low interest rates that we see currently? So here, I think one of most important speeches was given by Oliver Blanchard, but also somewhat controversial at the American Economic Association meeting in 2019. So Blanchard was talking about fiscal and welfare costs of debt. And so he was arguing that currently debt has no fiscal cost in developed countries, in those countries, again, where the debt to GDP ratios are so high. And this is because real interest rates are very, very low. They are so low and they're lower than real output growth. So if you think about debt to GDP ratio and how it evolves over time, if government takes on debt and government doesn't pay this debt back, but just roll it over period by period, that is going to be growing with an interest rate R, whereas output growth is going to grow with higher rate. So the ratio, debt to GDP ratio, is going to decline. And if you think about the limit, so at the very, very, very long horizon, it basically goes to 0. So Blanchard was arguing that there is no big deal of having very high levels of debt in the environment with low interest rates. Yet he was emphasizing that it could be welfare implications of very high levels of debt. So what type of implications? Well, if there is a lot of available government bonds in the market, and so government borrows a lot of money by issuing debt, someone has to hold this debt. And so investors are going to hold this debt, and there would be crowding out capital allocation. So there would be capital accumulation channel that is going to be hurt by this very high level of debt. And Blanchard was analyzing wealth implications also in the context of dynamic efficiency and inefficiency. And he was telling that a lot depends on the level of the marginal product of capital. And his conclusion was that even though debt has no fiscal cost, most likely it has some welfare cost, but this is limited, again, given the current economic environment. Yet the third point, which was pretty important that was made by Blanchard, is that in principle, there is opportunity to observe multiplicity of equilibria in the market, in the environment with very low interest rates and high levels of debt. So if investors believe that debt is riskless, they're not going to ask for high compensation for holding this debt. But if investors start believing that debt is actually risky, they will require compensation for holding debt. So interest rates are going to go up, and so that will become endogenously very risky. So this is the situation one would like to, in principle, of course, avoid. So Barro was developing on the ideas of Blanchard, and again was analyzing the difference between real interest rate on government bonds, rate of marginal product of capital, as well as output growth rate. And he was thinking about the opinion of Blanchard about zero fiscal cost of debt. And he was saying that it's not clear that the fact that interest rates are below output growth G will give opportunity of to government to roll over debt infinitely. And so kind of government could kind of run a Ponzi scheme. And this is because we observe that average interest rates are below average growth rates, but we don't have any guarantee that period by period interest rate is going to be lower than the growth rate. And so a little bit wrapping up this discussion, I would like to say that many economists disagree with Blanchard about the idea that debt has no fiscal cost. And so this is almost riskless to roll over the debt, even though Blanchard himself pointed out that it could be bad equilibrium. And the reason why economists disagree, because they think that government debt is risky. So what does it mean government debt risk is? So we have observable market prices on CDS contracts, on sovereign CDS contracts. And in the recent past, there were a number of papers that try to interpret CDS spreads from the perspective of probabilities of observant fundamental default. So what type of fundamental default? It's a default where in which government has to default because it cannot sustain government's intertemporal budget constraint. So it's not a strategic default, it's a really default that has to take place. Chernoff, Schmidt, and Schneider shows theoretically that they can rationalize observable CDS premiums that we've seen from 2007 to 2016 in the model with monetary and fiscal policy and in the model in which default happens endogenously. Dittmar, Souros, Saleh, and Simasek make a related point in a no arbitrage model. They try to relate pricing of inflation indexed bonds and nominal bonds and the difference between them to the sovereign default risk. And they look at the evidence from 2008 to 2015. Palara and Ren build up on the previous studies in terms of thinking about credit risk of government and how this is reflected in CDS spreads. They collect a panel data for different countries, a number of CDS contracts, so term structure of CDS spreads during the period from 2007 to 2018. And what they are going after is actually quantify fiscal space. So I've already told you that for every country, in principle, there is some limited number of debt over which government cannot go. So they try to think about what would be this debt limit and what would be the difference between that limit and current level of debt or fiscal space. And so they make a number of interesting points through the lens of their model. So first of all, they emphasize that fiscal space is time varying. So for example, if I tell you that your specific country is far away from that limit right now, it doesn't mean that tomorrow everything is going to be good, because tomorrow everything will depend endogenously on economic environment. So just for the interest of presenting some numbers to compare with the data that we have, average fiscal limits as a ratio of GDP for United States of America is 110% for the specific sample they looked at. So this is excluding COVID shock. And in Russia, for example, is 20%. So now if we look at current debt to GDP ratios in USA, current debt to GDP ratio is above this fiscal limit, meaning that according to these authors, there is a non-negligible risk of default, whereas in Russia, the number is 18, which is just below the fiscal limit given by proposed period, given by the model estimated on the data from 2007 to 2018. But I think this is more for illustration, but I think the interesting point one could make here is that if you forget about the difference between average fiscal limit and specific current level of debt to GDP ratio, but just eyeball the numbers. So gross debt to GDP ratio in USA is so much larger than in Russia, but you see that fiscal limit in the USA is also so much larger than in Russia. So what I would like to emphasize here, that it's not enough just to look at debt to GDP ratios, even if you take also to account deficit to GDP ratios and some numbers that was suggested as tipping points. Every country has its own fiscal space, and it varies again with the business cycle. So
you are running out of time.
Okay, so I'll try to wrap up. So let me wrap up my discussion on sovereign default risk. I just wanted to mention that there is a paper by piece by Boyarchenko and Shakar, who actually challenged the view that CDS premiums reflect fundamental default risk, and this is because in the recent past there are very few transactions in CDS market. Okay, so this is an interesting point. So Per, can I have a couple of extra minutes?
Okay.
I'll skip some other details. So here, basically, there is a recent paper that is looking at intertemporal budget constraint of government from the perspective of understanding whether we see it being held in the data. So Jank, Lustig, Van Nieuwenberg, and Xiolan compute the market value of debt using observable prices. And then what they do, they also compute the discounted present value of future surpluses. So surpluses are observable, and in order to figure out what is the discount rate they need to use, they use a model that prices stocks, bonds, real and nominal, and stocks in the item structure of stocks. So the argument of this paper is that the budget government constraint doesn't hold, and there is a huge gap between market value of debt and the present value of government surpluses. And this is because the primary surplus is very risky. So the present value of expected primary surpluses is a negative number, whereas the market value of debt is a big positive number. So Cochrane challenges this view based on some of the assumptions that made in Jank, Lustig, and Van Nieuwenberg. For the interest of time, I'm going to skip this debate, but let me introduce an interesting line of research that emerges from that debate, or relates to that debate, to be more precise. So a number of authors argue that government bonds are very special assets. And they could be special for different reasons, for reasons of safety and for reasons of liquidity. And there are papers on both, that go in both directions. So a number of authors interpret evidence presented in Jung et al. Paper, and these are Brunner, Merkel, and Sannikov and Reis, as evidence that government debt has a bubble component. And so this bubble component is basically a component that underlies the specialness of government debt. So people want to hold debt over and above just cash flows associated with debt, but also for the reasons of properties of government debt. So this looks like a big relief if you think about big levels of debt, because this kind of works as a seigniorage. Yet both Brunner et al. And Reis emphasize that these bubbles can pop. So bubbles are endogenous, so basically bubbles can burst. And so all of this just suggests that government fiscal policy has to be clearly thought through. And so there is another paper which is looking more on the liquidity aspect of bonds, again, emphasizing that bonds are very special, government bonds are very special assets, again, rationalizing the difference between market value of debt and expected present value of future surpluses. So I will skip this slide that was dedicated to the discussion of government debt and risk premia. So because government debt is so important, obviously it has implications for risk premia. I think we will hear about them from my colleagues. And let me conclude by saying that we are living through very unprecedented times, very unusual times, and hence we have unusual economic environment, and governments have to take unprecedented measures. Caution should be, we should interpret indicators of financial resilience with caution. So there is no single indicator of financial resilience that would summarize the state of the debt and the health of the fiscal situation. And even though government bonds can be special assets, there is no free lunch in financial markets. Thank you very much, and apologies for being over time.
Thank you. We have a number of questions coming in already. I'll save some since they include EU-related topics, so I'll leave that to Martin. But Göran Robertsson here at the Swedish House of Finance asks Irina a short comment on this. Is debt sustainability affected by who are holding the debt, e.g. foreign versus domestic investors? Göran has worked at the Swedish National Debt Office, so he has experience with those questions. Do you have a comment on that?
Well, yes, and I think even so, kind of giving some perspective on the question, I think it's not only about who holds debt in terms of foreign or domestic investors, but also there is a debate now in terms of what happened, how to think about the situation when debt increases and the debt is, the level of debt is very big. We have Treasury gives additional debt issuances, and this debt goes to the balance sheet of the monetary authority, of the central bank. But people are worried about this situation, fiscal dominance. So what would happen when situation will start changing, when inflation is going to suggest, when inflation starts increasing? So would the central bank sell this debt, and so on and so forth? There are different views on the issue. Again, given the unprecedented situation in which we are now, perhaps this is justified, because if that was in the hands of private investors, that would also kind of crowd out investment into firms' capital accumulation. And given economic fundamentals, perhaps it's not per se a very big problem, but something to think about.
Okay.
Definitely.
We might come back to that. We have more questions, but as I said, I'll save them. And please keep the questions coming. We'll have time for more of them. But in the meantime, Kristin, now the floor is yours. Or the air.
Thanks very much indeed. And thanks for inviting me and the kind introduction. And also thanks to Irina for a very interesting presentation. I am going to base my remarks around 3 questions, which I think we will have on the screen very shortly on the next slide. So the next slide, please. Otherwise, I'll just start because at least my screen is frozen. I don't know about yours, but mine is frozen.
Yes, yeah.
I'll start anyway. So the first question, as a market participant, I would ask myself is why and how much public debt is rising. You cannot really assess debt sustainability without looking at what will you use the debt for, and how does that tie into the indebtedness of sovereign you already see and the business cycle situation. So very much along the lines of what Irina mentioned. I think for any financial market participant, they would certainly agree with Professor Blanchard's view that it's growth rates, it's interest rates, it's borrowing needs that matter. I don't think anyone would be so bold to say that the fiscal cost is 0, but you would certainly be more in that sort of mindset that looking at that sort of flow parameters compared to the stock versus flow analysis we would do in standard debt sustainability analysis. Another issue that cannot be stressed enough when it comes to the market view is that you'd certainly be looking at forecasts, but you also be thinking about outcomes. Because it's one thing to announce your big spending program, it's quite a different thing to execute on it, as any politician would know. So you're being very mindful of the electoral cycle. You would certainly discount that some initiatives are likely promises, while others will indeed be carried out. And within the sort of use of proceeds or the initiatives, financial markets would probably have stayed close to the view that fiscal multipliers vary a lot by initiative, by type of fiscal policy, even though while all of this was out of fashion elsewhere, and obviously also depending on the degree of slack in the economy, etc. So I think you would find that the financial market view would be closer to what we would, the sort of short-term analysis we would typically look at when a country is about to lose market access, relative to the very long-term debt sustainability analysis that is carried out typically in institutions such as the IMF or, for that matter, the European Commission. The second point I'd like to make is that you cannot look at the sustainability or whether you should worry about rising public debt without looking at the overall policy mix and the overall policy stance. So we're coming from a period where there was a large reliance on monetary policy as a stimulus tool, while fiscal policy and financial sector policy were relatively tight. I think that can by and large characterize many countries after the great financial crisis. And what this brought was fairly weak growth, inflation below target, mildly negative real rates, and soaring asset prices. And what's interesting now, I think, is that there seems to be this strange, or not strange, but quite striking consensus on from everyone from academic to market participants to politicians, and last but not least, voters, that probably we can actually do a bit better than this. So at least, there's a chance that fiscal policy at this junction is more effective at achieving what we want. And I personally think this is a positive thing. I think it's good for credibility, because if you set out to, achieve economic growth, less inequality, or what have you, you'd like to be able to achieve it. I think it's also good for accountability, because you're able to vote people out of office in case you think the politicians don't deliver. I think it's good for legitimacy, and especially also the legitimacy of central banks, who I think have, given their restricted mandates, have had to play a too large role. The last part I'd like to talk about is around financial market concerns, because it might certainly sound here that as if I am very gung-ho on the whole issue of rising debt. And let me start with default risks. Default risks are not very much at all the center of attention for the time being in financial markets. And one reason is that default risks are so intimately linked to the policy regime you're in. default risks are not only about what an individual country will do in terms of level of deficits, etc. So if we take the example of Greece, for example, during the sovereign crisis, much of the default risks centered not only on Greek fiscal policy, but rather what the European Central Bank would do. Would it still accept Greek debt as collateral, etc.? Where would that leave the banks, the Greek banks who were dependent on liquidity support? So with a more complete architecture in the euro area, as we like to put it, I think certainly the default risks, especially in the euro area and also elsewhere, have gone down. Instead, it's inflation fears, which are very much taking center stage. The reason here, of course, being that one fears that a too expansive expansionary fiscal policy would bring about inflation above target, and even above target for a longer period than what central banks would then accommodate within their more or less explicit average inflation targeting frameworks, and etc. Then you would have raising rates earlier than expected. Different asset classes react differently to rising rates. For equities, it's the very short end of the curve that matters. And for credit, for example, you'd want a mildly or ideally a strongly negative real rate through the curve to get strong performance. So certainly fears in financial markets around inflation. Short versus long run is another, I think, important distinction between financial markets and the policy circles, if you will, or for that matter, the infinite horizon in academia. So short run here would probably be around the weighted average maturity of government debt. So 5 to 7 years somewhere is the horizon, which is the maximum you're looking at. Picking up on Irina's points around safe assets, I would also just like to state that it's not the privilege of financial market to define what is a safe asset. This is really the privilege of the Basel Committee and the central banks who decide what to accept in their collateral frameworks, etc. So from the view of financial market, something is safe until the Basel Committee says it's not safe anymore. So in that sense, you'd rather looking at policy risks, I would say, relative to the credit risk of the assets as such. Finally, it is obviously a big difference from a financial market perspective, whether it's a small or a large country. That can be both a good or a bad thing, depending on which kind of investor you are. If you're the more speculative kind, maybe you like a small country because the movements you're going to be able to play will be very large. But for most, if you're thinking about sovereign debt as having this sort of insurance or liquidity characteristic, which are, after all, probably the most important reason for holding it, you like a large country with a stable currency regime. The more depth, the better. The more domestic investors, the better. And the more liquid derivatives market, etc., the better. Thank you.
Thank you very much. We have a bunch more of questions, but to be on the safe side, I think I leave the word to Martin Åström immediately, because a number of the questions relate to EU and next generation EU and what is happening and in this context. So please, Martin, the next 10 minutes are yours.
Thank you, Per. Can you hear me and see me?
Absolutely, and see you.
Excellent. So many thanks to Per and to the Swedish House of Finance for inviting me to participate in this webinar. I think it's a very topical question and very thought-provoking. Also, I think the question of whether or not we should be frightened of large public debt is actually undergoing a real-life testing these days. So it's very topical and very interesting, and I'm happy to be given the opportunity to give the Europeans' perspective a bit on an issue where not all macroeconomists agree. There's one or two of those issues out there. I'll just get out of the way a tedious but necessary caveat that I am an official with the European Commission. So of course I express myself as such, so I have probably slightly less free role than the others on the panel. But I will not completely shy away from giving my more personal views sometimes and not the official Commission views. I'll try to remember to say so when I do. Maybe you'll notice anyway. So when I was asked to participate and saw the headline of the webinar, I immediately thought of the debate over since the past 10 years and the last crisis, if you like, and where I think that the debate on the public debt has shifted. I think in two ways. There's one very recent shift and one that has been more long term. And Irina and Kristin have touched upon it, of course, already. I think there's one shift away from the perspective that was very prevalent across a lot of global institutions, such as the IMF and also European institutions during the last crisis. Those were times, of course, when many countries in Europe were facing rising debt due to what became for the EU a sovereign debt crisis, and the focus then was very strongly on budget consolidation at that point. And I think we would now, from the Commission side, even say that probably that focus was too strong too quickly, that the taps were turned off too soon, if you like. And perhaps too much focus on the numerator in the debt to GDP ratio and too little on the denominator, because of course the ratio is decided by movements in both. So, and then the reasons for that shift, in my view, can be traced to some extent to lessons learned from the last crisis, and to the experiences seen in some countries, but also to the fact, of course, that and that's an empirical question, we continue to see persistently very low inflation, too low even. We are seeing interest rates being exceptionally low, and this is even in the presence of, as we just heard, some very large-scale innovative monetary stimulus instruments that are used widely. So I think that is one shift that has happened over the last 10 years with regard to the view on government debt and whether or not it's risky or not, or how risky it is. Then there's a second shift, and that is very much recent and totally different in character. And it's been brought on by the nature and urgency and unpredictability, not least of the COVID pandemic. It's very different in nature from the previous crisis, of course, but I think the first shift, which I just tried to explain, that I think I've seen, it interacts with how we react to this one. Or rather the first shift perhaps has been more theoretical, conceptual, or intellectual, if you like, and now the second shift is completely forced upon us by circumstance, by the literal spread across the world of a deadly threat, which we have only been able to protect ourselves against by shutting down parts of our economies. So that's a totally different animal in a way, and it's a shift that has been thrust upon us. But it has been thrust upon us, I think, in a conceptual and intellectual context that was ripe, if you like, more ripe than 10 years ago. So of course, we all know we've seen significant increases in the debt to GDP ratio all over the world, and not least in Europe. And it's the worst economic contraction ever for the EU. And it's a result of a mix of increases in spending, but also falling revenues and low GDP. So it's a trifecta of bad things, if you like. So, and of course, we've also seen this debt burden eased by exceptionally low interest rates. And it's just been mentioned by both Kristin and Irina. But even in the context of exceptionally low interest rates, it's clear that the situation raises questions with regard to the sustainability of having very high debt levels. And I think Per will have us delve further into it as the seminar continues. But so I may not go into detail here, but from the Commission's perspective, if you want to answer the question about whether or not debt should be something to be scared of or not, we would need to answer the question of what kind of debt it is and what it is used for. So to put it very, very bluntly, if it's to finance research or education or infrastructure or hospitals, we would tend to see it as good debt. And if it's to finance, by contrast, if it's to finance current expenditures and measures that have no or little impact on productive capacity in the economy, then it would be seen as bad debt, and then debt sustainability will come into question. And what we would like to see from the Commission side, and this is something that is shared by member states as well, that we take advantage of the current very low interest rate environment to grow out of debt through investment and reforms. And I think this is a bit a shift in thinking. And that rationale or that thinking underpins now the reaction by the EU and by its member states to the pandemic and to support the recovery of the European economies. And I'll linger very, very briefly on that response, because I think it's worth highlighting how extraordinarily quick on its feet Europe has been, actually. The pandemic was officially declared in mid-March last year. And then, and only four months later, in mid-July, the EU leaders decided on this unprecedented support and recovery instrument, which is called Next Generation EU. I see in the questions that many in the audience know about it, which comes to about 800 billion euros in current prices, of which half then is grants to EU member states, and a little more than the other half is through union loans provided to member states, where for the first time the EU is borrowing with its own budget as collateral, if you like. So if you add that to the long-term budget, then we're up to something over 2.4 trillion euros over the coming 8 years, 7-8 years. And then we can add to that everything that the ECB is doing, of course, to keep borrowing costs low, and not least the PEPP program. In Swedish, it's called it's the PEP program. I think it's very suitable. So, and now from the Commission's point of view, we now have a crucial task along with member states to monitor how this money is spent. Kristin mentioned that it's one thing to find a lot of money, and another thing spending them wisely. So we want this to go to good debt, if you like, to investments, not least to support the green transition and the digital transition, so that it goes towards sustainable growth, of course. Technically speaking, I think I've done my 10 minutes. All member states have now submitted their recovery and resilience plans to the Commission, and we will now review them, and then the member states and the Council will adopt them, and the facility can start transmitting money to member states towards the autumn or winter. So I think I've done 10 minutes, Per. I'll stop there.
Thank you. There will be time to return to some of these questions. We have a bunch of questions from the audience. I think one thing in this debate is that there are people who argue, Blanchard is one of them, and Larry Summers, that things have changed. We need to sort of look at old solutions and question them. And if we have a savings surplus, that may be with us for a long time, and low interest rates for a long time, maybe we should look differently at debt than we have done historically. Johanna Lübeck-Lilja has one question saying, some are arguing that changes in the EU Stability and Growth Pact, saying that the rules on fiscal prudence are too strict. What is your view? Will this happen? And what effects could that have on fiscal discipline in the EU and eventually on the stability of the EU economy and the euro? I mean, one way to phrase it, if debt was considered very dangerous 10 years ago or 15 years ago or so, is it still, with low interest rates and more saving than investment, should we look at sort of the rules we have? Who would like to try that question?
I'd be happy to start on that one. It's certainly a broad question, Johanna. Could we fit anything more in there, maybe? No, I'm just kidding. So
she has more. She has more.
She has more. Oh, I'm sure. That's great. And I've been missing those questions, Johanna, I should say also. What I think this discussion brings out very clearly is the need to take a more granular look. That basically you cannot only be looking at the overall ratios, because first of all, you're comparing stock to flow, which makes no sense to begin with. And also you are not looking at the quality of spending, you are not looking at the previous fiscal stance, what is due to a primary surplus or deficit, what is due to interest payments, etc. What does the composition, the maturity structure of debt look like, etc. So what I think is positive now is a willingness and an openness from the Commission and others to take a more granular view. And I think this suggestion floated by Summers, I think it was, that you would be looking at interest payments in relative to GDP, and stay within certain, so to speak, broad parameters over a time horizon would be a fairly pragmatic view to look at it, because frankly, you don't know where interest rates are going and you don't know where growth are going. But if you're trying to stay somewhat within the historical average, you have a good chance at least. But yeah, and the big, I'm going to pause there before I tackle the bigger area questions to let the other participants talk.
Martin or Irina?
I can maybe just say that I agree with you, with Kristin on what she just suggested. So especially I think nowadays after the COVID shock, over and above all the reasons that Kristin already mentioned, it would be a little bit not justifiable to look at the previous kind of debt to GDP ratios benchmark numbers, even though they're not per se, debt to GDP ratio is a very good indicator. Aside from that point of view, the COVID shock brought about a big problem and paralyzes the market across the entire globe. So countries took on debt for a good reason. Hopefully, as Martin suggested, it would be also spent wisely and invested in economic development rather than anything else. So I think the recent increase in debt levels is justifiable. So as I already mentioned in my presentation, I think it's very hard to pin down what would be one single indicator of resilience. I'm not sure interest rate payments versus GDP would be one. It has advantages, but it also has disadvantages just because interest rates are not fixed, they're time varying as well. So there is a risk in there. So debt to GDP ratio is not perfect benchmark or a good benchmark, not only necessarily because it's, in my view, stock to flow. So we have in economics many ratios that we are looking at. For example, price to dividend ratio. You can think about price being kind of a stock and dividend being a flow. And so we know the price dividend ratio is pretty good for signaling risk premium in financial markets. But more the problem with the debt to GDP ratio is just because countries are so heterogeneous. We need to think about how much fiscal space they have. There are many methodologies out there in academic literature, at least, that suggest how to compute fiscal space. And I think there is no ideal one, but maybe that would be a way to go to try to develop a methodology that would take into account policies, as Kristin mentioned in her presentation, a mix of policies and economic environment in order to try and come out with a kind of aggregate measure of, as an indicator of fiscal health and fiscal resilience and fiscal space.
Okay, thank you, Martin.
Thank you. I think a lot of very wise things were said just now by both the other panelists, but I might say something about the Stability and Growth Pact, because it's mentioned here. We are, in fact, in the middle of a review of the entire economic governance framework. We launched a public consultation document on it last year. I think it was February, and it's been put a bit on hold, or rather extended, if you like, due to the pandemic. But there is a lot of thinking on in the Commission and in member states on the Stability and Growth Pact and how it might be made even more fit for purpose. So, but I'm not in a position to really say where we would end up. And indeed, we're in a public consultation, so I don't want to precipitate what comes in from that. I think just a few words also on the because we have these famous ratios, of course, or rates, the threshold values, rather, 3% of GDP and the 60% of GDP, and of course some people might question how relevant they are over time and so on. Of course, from my perspective, from our perspective, they have whether or not one questions the economic relevance of them or their aptitude, how apt they are to measure things. For us, they have a very legal and political relevance. They're actually in the treaty on the functioning of the EU in Protocol 12, and which can only be changed by unanimity. So again, we are in a world where these are extremely stable, if you like, right? Now, let's say theoretically that the debt threshold was revised upward from 60 to 90, then I think we would probably even still end up with having to have the 3% threshold. When the 60% threshold was set in the Maastricht Treaty days, I think we had an expected average growth of about 5% per year, and now that is revised down to about 3%. So I'm not sure it would change a lot, even in that very hypothetical case. But then what Irina said, I'd like to pick up on that, on the granularity, and Kristin as well. I think that's very important to not think that, of course, the debt to GDP measure can measure everything. Certainly, if you're in a currency union, there are lots of other metrics that you would need to look at in order to ensure that you don't have too large externalities. So you would need to look at current accounts, for instance, which is why we have this macroeconomic imbalances procedure and monitoring exercise. So it's not all about the debt; it's also about how because we're inside the euro, economies are so integrated. So externalities become very important. I think there's an epistemological tendency among us humans to want to find when we have a difficult problem, we want to find a simple solution. And I don't think so. I agree that debt to GDP ratio is not the answer to all those questions. You need to be more granular and look at other things, not least what money is being spent on, and how individual economies inside the currency union relate to each other, and what spillovers are. That's definitely equally important. But from our perspective, from the very formalistic, and we have lots of lawyers in the Commission, it's in the treaties, so that's we can't get around that.
Okay. Thank you. We have at least 5 more questions, 15 minutes. That's 3 minutes per question to answer them, and they are not small questions. But could we try to sort of just give the some sort of sense for Jonas Niemeyer from the central bank, the Riksbank in Sweden, asks, how do you view the rising public debt levels in the EU, given the rising cohorts of retired inhabitants and given the large public expenditure on health costs in the EU, the more structural issues? Does anyone want to try a short comment on that one?
Well, a very short one would be that I guess we also need to be looking again at debt service burdens, because what's the cost of servicing that debt in a world with lower interest rates compared to yesterday? And the second one is the same thing as we've seen with pension reforms. There might be a move from stuff that is currently being provided through public means to private means if there is a need to then consolidate public finances on the back of excessive sort of expense growth. So I think the challenge there is more of intra and between generational equity, which I think will be a political issue rather than at least for the market one, a major concern.
Okay, thank you. Quick answer, Jia Chen. As Martin just mentioned, this is a couple of minutes ago, a lot of developed countries nowadays face low inflation rate and high debt to GDP ratio. Will this be the new normal for the whole world? is there any theory that explains the rise of such phenomenon? Who wants to try a short answer to that one? Martin,
I can start maybe quickly. So at least before the COVID crisis, so there is some research on this problem, and so specifically for the US data, it's Ricardo Reis, a professor at the London School of Economics, with his co-authors. So they looked at derivative markets, inflation swaps, and some other derivatives related to inflation, I believe. And they particularly were interested in understanding how come the debt in the US is so large. So what would be the way to get rid of the debt? And so there are usual suspects. You can tax a lot. And then the second one, you can inflate the weight, real value of debt. So with high inflation. And so it looked like market participants didn't expect high inflation to kick in. So there were very, very slim probabilities of seeing relatively high inflation in the near future.
Right.
There is also research that tried to look at how much you need to tax to get rid of debts. And so again, it doesn't look like, at least given historical evidence on revenues, expenditures of government, and overall dynamics of debt, it would be possible just to tax the debt. So it would be possible to basically to impose such a change in the taxation that you would get rid of the debt. But there were also historical episodes with very high levels of debt. The debt was repaid, and so times are different, but there are ways to repay the debt if debt is raised for a good reason, for investment and economic development. And there are also other ways how government collects money, again, through liquidity premia, so through convenience yields. Now, as I already talked about, there is some evidence that there are bubbles in government debt. So market participants need these assets for other reasons rather than cash flows. Mm. And again, I agree with Kristin with a lot what she said. A lot depends on the mix of policies and economic environment.
Thank you. Let me continue with the questions. Johanna Lübeck-Lilja. Again, many voices are raised for the EU Next Generation Fund not being a one-off, meaning that the EU would continue with common borrowing, also going forward. Christine Lagarde, as well as the Spanish and Greek prime ministers, are among those arguing in favor of this. A potential green government in Germany could also change the traditional, more skeptic German view on common borrowing in the US. What is your view? Could this happen? Sounds like it could be something for Kristin, maybe.
Thank you. Well, from a market perspective, if you want to issue substantial amounts of debt, because I would say that the current issuance done by the Commission, etc., is fairly limited from a market perspective, you do need some sort of taxation capacity at the same level. If we take in the correspondence to the US, you have a federal taxation, you have state level, you have municipal, and you then have the debt to correspond to those different taxation levels. So I think without the joint taxation capacity, which I understand there is very little political appetite for, then there's really a limit to how much you can issue. And then it will be rather in the form of sort of supranational debt than something that is a Euro government. It's so for markets, it's a bit of a different animal.
There is a debate that the EU would need a risk-free asset.
Again, from a market perspective, if you would be able to issue sufficient amount for it to play that role, it's very hard to see how you would do that without having the taxation authority to back it up.
Right. Martin, any comments?
No, I mean, traditionally the Commission has been cautiously supportive of the idea of a common European safe asset, even during the previous Commission, the Juncker Commission. It was raised in a number of our communications, but we've also been of course realistic and cautious with regard to how you would design it and whether or not you could find the political opportunity, not least to actually create one and to get politicians to agree, to speak frankly, right? I think I totally see Kristin's point. We would say, I mean, what we have now with the current low borrowing by the Commission is not only is it limited from the global financial markets perspective, it's also temporary and ad hoc, if you like, to deal with the COVID crisis. And whether or not things will go back to normal or not, I don't. It's anyone's guess. Certainly, a lot would need to happen, right? It wouldn't be, in my view, it wouldn't just be to extend things just by simple decision. I think a lot would need to happen politically, but I don't want to speculate too much. I really took my Commission hat off there. I almost took my Commission hat off, putting it back on.
We appreciate that. I have one last question from Guess Who, Johanna Liebek-Lilja. And then to round it off, I want to ask you the title question. Should we worry about the rising public debt, all the three of you, before we round up 5 minutes from now? Her question is, if inflation impulses are more than temporary, many US countries would struggle with servicing their high public debt if the ECB raises interest rates. Do you see a potential conflict between fiscal considerations and monetary policy, particularly within the EU, or will the central banks let public debt inflate down? I think we have touched upon it in a couple of times ago, but would anybody dare a short comment on that one?
Well, it will be a very tricky situation to navigate for the central bank, because not only will you then have the consolidation of public debt, you also have elevated private debt burdens, so you will have a double whammy to growth if you tighten too much. So I guess it will really be a challenge of trying to have something very, very well announced. It's by no means impossible. The Federal Reserve has done it several times, but you know what you're looking for is to try to do the Yellen thing. It's going to be so boring, so it's like watching paint dry, which is not so easy in real time. But that would be walking a tightrope between independence and an inflation target.
Okay, we're almost out of time. Let's take it in reverse order. Martin, should we worry about the rising public debt?
Well, as I went into it a bit before, for me it's an easy answer to question, because it's stated in the treaty that we should. Yes. Okay. Of course, but then you did say we could qualify. So of course, I mean we've been into it a bit before that it depends. Fundamentally, and that's what we're seeing now, and with the Next Generation EU, that it depends on the situation. It depends, of course, on the kind of expenditures, on what we think about the long-term interest rate, and to what extent, fundamentally, to what extent the borrowing can be translated into investments that will deliver growth. And and then lots of other technical aspects, of course. Is it borrowed in your own currency or not? What length of maturities? We have a longer length of the maturities now than we did. That's good, but that doesn't change that all debts will mature at some point. So yes, but it depends on the situation, and we saw in the beginning in Irina's PowerPoint that there's you could have Japan having, was it 256% ratio of debt to GDP, and we don't see Japan as a failed economy or failed state, and I think that is because almost all of that debt is domestic, right? So whereas we had small economies who had borrowed in a currency which they didn't control, and then it's a totally different issue, even on much lower ratios. So it depends, unless you read the treaties, of course.
Thank you. Kristin, an even shorter yes or no answer.
No, not yet. We shouldn't be worrying yet.
Thank you. Irina, you have the last word.
I should balance. I think we should worry, but we don't need to panic. And I think the current rise of debt is justifiable given the shock, the negative big demand shock. But when I say we should worry, we should think about how we are going to service the debt, and we should think about design of monetary and fiscal policy that don't contradict each other. So they go hand in hand so that situation is stable and the debt goes into economic development.
Great. Thank you so much, Irina, Kristin, Martin, the audience, all the questions. We appreciated a lot. I learned a lot. And welcome back to the next seminar at the Swedish House of Finances. It was great having you here. Thank you. Bye.
Thank you very much.
Thank you very much.
Have a good afternoon.